You're watching Silver News Daily. Subscribe for more.
Imagine this, silver skyrocketing to $1.75, becoming the top-performing asset of 2025 right before the biggest financial collapse since the Great Depression reshapes the global economy. Sounds like something out of a sci-fi novel, right? But here's the kicker. It's not. Today, we're uncovering the shocking predictions behind silver's pre-bust rally, how it could triple in value, and the hidden forces setting the stage for a post-collapse price explosion. This is a story about silver's once-in-a-lifetime golden moment that you cannot afford to miss.
I thought we'd get a year-end rally, and obviously that didn't really happen till today. But not a lot is changing out there. I think we're kind of slowly gravitating towards lower inflation levels and a recession ultimately. But with the election in the fall, it kind of stretched things out. I think the Biden administration put all kinds of things through the government to try to keep the economy propped up and help the Democrats in the election. Didn't really help them, but now we're probably going to have payback, I would guess, in the first half of this year, this coming year. So, but it doesn't really change anything because that's what I was expecting anyway. It's just kind of getting there a little more slowly. I think we are ultimately heading for a global bust still, and that I still expect that in 2025. I've said recently, I think what we're seeing in China, particularly with what you've seen in their interest rates and, basically in deflation now, I think they're leading edge of this global bust. They are more levered than anyone else. They have more excesses than anyone else, and they're running into more problems than anyone else right now because of their dependence on real estate. And I think it's just a matter of time before the rest of the world catches up with that. So I think that's probably going to be the big story of 2025.
Silver's climb in 2024 wasn't just impressive, it was a warning shot for what's to come. The precious metal broke the $30 mark after surging industrial demand from clean energy projects and a booming electric vehicle market. In fact, India alone imported more silver in the first 4 months of 2024 than in the entire previous year. And it's not just industry fueling this rise. Central banks have shifted strategies, stocking up on silver and gold to hedge against inflation and mounting geopolitical risks. The Federal Reserve's rate cuts added fuel to the fire, driving investors toward hard assets as the US dollar weakened. But here's the key question. With demand skyrocketing and supplies dwindling, how much longer can silver remain underpriced? Stick around because we're just scratching the surface of what's driving silver's unstoppable momentum.
Would not want to own a long duration bond going forward for probably the next several years, for the next decade maybe, government or otherwise. And at that point, your fixed income strategy is still kind of fixed income. Your fixed income strategy going forward from the bust, and you might be okay for a few months into the recovery, but going forward would be rolling treasury bills. So you buy 6-month bills, and every 6 months you'd be rolling them at a higher rate. Once that rate cycle starts ratcheting the other direction, and you do that for the balance of that, whether it's a 6 or 7 year cycle, and you'll start rolling T-bills at, let's say, 0 or 0.5%. In the first year of the recovery. By the time you get into the 5th, 6th, or 7th year of the recovery, you'll be rolling treasury bills at high double digits, and you won't be suffering the if you buy a bond, you're locking yourself into the rate you buy that bond at. So if you buy a bond at 1%, that's going to be a big loser as rates go to 14 or 15%. If you buy a bond at 5% and rates go to 14 or 15%, still a big loser. So staying away from bonds will help your portfolio immensely. And just understanding that you may have to give up early on. You're going to be choosing between, a bond yielding 1%, a T-bill yielding 0. But you're going to be better off in that T-bill because within a year you're going to be, or maybe even sooner, you're going to be having the T-bill out returning that 1% you locked yourself into on the bond. So staying away from locking yourself into rates when you're near the bottom is the absolute.
Now let's talk about the Trump factor. With his return to the presidency, sweeping pro-business policies could shake up the silver market in ways we've never seen before. Trump's push for deregulation and streamlined permitting could be a boon for silver mining, accelerating supply, but it's not all positive. Here's the catch. Trump's proposed tariffs on China and other major economies could spark inflation, pushing costs higher across the board. And while a strong dollar might make silver pricier in global markets, these same trade tensions could drive massive safe haven buying as investors look for shelter from the storm. But what's the bigger picture here? But Trump's policies actually set the stage for silver to soar past $75. We'll unpack that as we dig deeper into how geopolitical and economic forces are reshaping the silver market.
Mind, interest rates going down means bonds going up. So if I'm looking for rates to go, I'll just use the 10-year. If I'm looking for the 10-year to go from 460 to 2.5 in the next 6 months, let's say, that's obviously very bullish for a 10-year treasury, and it'll be very bullish for all long duration treasuries. I also think it'll be bullish because I think stock market's going to be going up. People are going to be looking over the trough. Even if the economy is slowing, they're going to be saying, yeah, but the Fed's easing, so we're going to factor in that by 2026 we're out of this and we're growing. So they're going to be positive for corporates too. So I think in the next 6 months, certainly the next few months, you can buy both government bonds and corporates. As we move closer to the end of this cycle, as the recession gets more and more, comes into vision, I think you need to move away from corporates and only stay in treasuries. And then if I'm thinking that as the economy goes into recession and then ultimately a bust, that you move from 2.5 down to 0 over the course of many months, obviously there's only one game in town at that point. That's treasuries. You won't want to be in anything. You don't try to play spreads above treasuries. It'll be treasuries or bust, basically. So there's a crossover point where you can own both corporates and treasuries now, but there's a crossover point where you'll want to move everything to just government guaranteed bonds because that's the only thing that's going to hold up in the bust. And then there's a point at which you want to say, nobody's going to be able to pinpoint this, or very few. So I'm not saying you do it to the precise moment, but you'll want to say at some point, rates are bottoming out. If it's 0, it's 0. If it's a quarter, it's a quarter. If it's negative, it's negative. But somewhere down there, rates are bottoming out. And I would not.
Silver's role in the clean energy revolution and advanced technology is turning it into a commodity powerhouse. But here's the problem. The world simply doesn't have enough of it. Industrial demand is projected to hit a staggering 1.21 billion ounces in 2025, driven by solar panels, electric vehicles, and cutting-edge AI technologies. For example, just one nuclear reactor requires an astonishing 56,000 ounces of silver, and EV consume up to 50 grams per vehicle. Now multiply that across millions of units globally. Meanwhile, above-ground silver inventories are rapidly depleting, with experts predicting they could vanish entirely in the next 12 to 24 months. Major mining regions like Russia and Kazakhstan are struggling with production growth, creating a perfect storm of skyrocketing demand and shrinking supply. Here's the question. With industrial needs climbing and silver reserves running dry, how will this critical metal meet the moment? The answer may shock you.
Your rate was, as I said, directly a response to Trump getting elected and fears that we were going to see more inflation, bigger deficits. And that was pretty pervasive across Wall Street. That was the kind of the popular narrative. I think what you had, people forget, we had a drop from 5% down to 360 in the preceding 6 months. And so you went 5 to 360 back to 460, so maybe a 2/3 retracement type of thing. You have a lot of calls now, as happens when the tape moves that way, for 5, 6, 7% 10-year. I have consistently said, and didn't expect it, honestly, to get to 460, but I wasn't surprised by 440 or 450. But anyway, I've consistently said this is a counter trend move, and once it resolves, once it completes, we will see another leg down towards 3%. And ultimately, I think 250. And I am still saying, which I think I said last time on your show, I expect in the bust the 10-year to go to 0% and short rates to go negative. And again, you can see that if you're printing 20 trillion, if you're coming out with QE of 20 trillion, that means you have to be buying debt, right? They'll be buying every bond and bill they can get their hands on to put money into the system. At the same time, the government's still going to be, they'll be matching probably not dollar for dollar, but they'll be doing a lot of fiscal expansion. So there'll be plenty of new debt, but they'll be monetizing all the debt. So it won't be a problem of saying, well, there's a big supply out there and nobody wants to buy it. No, the Fed will be the buyer of last resort because they're trying to get money into the system. And I say the Fed, but it'll be every central bank in the world doing the same thing. So I think we do have one lower low in rates. Everybody thought the 2020 lows, when 10-year got down to 0.4, thought that was the end. Everybody's consistent. I'd say 99.9% of people out there, pundits out there, analysts out there think we've seen the historic low in rates and we won't go back there. We're going higher, not lower. I think we have one more leg down to new lows. That will be the secular peak in bonds, the secular low in rates. And then I think what follows that over the course of the next decade will be rates moving to secular new highs, meaning above the 1982 or 1981 peaks, when long bond got to 15%, T-bills got to 21%. I think we'll exceed those by early next decade.
The silver market isn't just about supply and demand. It's also a battlefield for corporate power plays. In 2024 alone, we saw monumental industry shifts with massive mergers and acquisitions. Companies like First Majestic Silver Corp and Kerr Mining spent billions snapping up rivals, positioning themselves as leaders in a rapidly consolidating industry. These deals aren't just about dominance, they're about survival. With dwindling reserves and skyrocketing demand, silver producers are scrambling to expand production capacity and secure future profits. But consolidation has a ripple effect. Fewer players in the market can mean less competition, tighter supply, and even more upward pressure on prices. So what does this consolidation frenzy mean for silver investors? Could it be the fuel that propels silver to unprecedented highs? Keep watching because we're breaking down how these moves could reshape the entire silver industry.
To say, well, you're cutting marginal tax rates, therefore you're going to get less tax revenue. Absolutely false. The problem we've had, the reason deficits have continued to grow has been spending, not tax revenues. Our tax revenues grow with tax cuts. So I think you're actually going to see better control of deficits. The problem is he has a big agenda, so there is going to be some spending there. So I'm not arguing we're going to go to surpluses, but I don't think it's nearly as dire as the bond market wanted to take it. And they drove interest rates up 100 basis points, pretty much on the basis of speculation about Trump policy being inflationary, and I think there is a bias in there that they just really think he's an idiot. But I think these are legitimate. It's a legitimate agenda with a very positive outcome, if not for the bust. So it might soften some of the bust if he succeeds. But I just think the macro trumps that. But anyway, going back to your original question, so I think that shrinking of breadth and the focus on saying the passive flows are going to a very small group of stuff. I think you're going to see in the next 6 months that's not the case. It's going to broaden out. You are going to see the value stocks come into favor, and it's not going to be growth stocks and the Mag 7 go to sleep. I think they are going to come back. I think Nvidia is going to much higher highs. I have a 400 target on SMH, which is down around 240, 250. So in other words, I'm not saying it's at the expense of the growth stocks. I think both are going to play. This is going to be and it's kind of unusual because usually as you move to a top, you do narrow and you do get you narrow right into a top where only a handful of stocks are driving the market. Kind of the nifty 50 of the early 1970s. But this one's going to be unusual in that I think we have the opposite. I think we broaden into the top.
Now, let's address the elephant in the room, the looming global reset predicted for 2025. Renowned Contra-Ryan strategist David Hunter has issued a chilling forecast, a massive 80% market collapse that could bring the financial system to its knees. And yet, amidst the chaos, silver could become the ultimate safe haven. Here's how it plays out before the crash. Silver is expected to surge as inflationary pressures and central bank policies drive investors toward hard assets. But when the bus hits, silver, like other commodities, may briefly decline. Why? Because in a full-blown financial meltdown, liquidity is king, and even precious metals often see short-term sell-offs. But here's the twist. As governments and central banks respond with trillions in fiscal and monetary interventions, silver's dual role as a monetary and industrial metal will set the stage for an explosive recovery. Could this be the moment silver not only survives the bust but emerges as a cornerstone of the post-reset economy?
Small cadre of growth stocks are dominating, et cetera. But I think you can't analyze during this last month because it's a consolidation. It's partly a consolidation of the moves that those value stocks had. So I expect very shortly, in fact, I think it may start today or maybe next week. But I expect we're going to begin the next leg up after this 1 month consolidation or whatever it is, 4 to 6 week consolidation. And I think we'll see this market get very steep and quite broad. As I said, I'm calling for 3,300 on the Russell. We got down almost 2,200 yesterday. That's 50%. The other averages are going to be up 30 or 35%. So we are, by definition, you're going to see a broadening. And a big part of that, the other part of what the last, basically a post-election period has been a backup in rates, right? People added 2 and 2 and got 6 in terms of Trump policies. They decided his policies were much more inflationary. Interestingly, I think, TDS, Trump derangement syndrome, was pervasive throughout even the economic community and certainly the CBO and the places that do these analysis. They're building in a bias towards saying, Trump's worse than Kamala, and the numbers are going to be more inflationary than Biden, et cetera. I don't believe that. I think going to a more pro-capitalist agenda and looking sincerely to shrink, move things out, like eliminate the Department of Education and things like that. I think we're going to be surprised at how much that can offset. And I don't. Again, this has been true really since Reagan. That people do not understand supply side economics. It is a legitimate argument, and I think it could be proven that it's happened over and over. You cut tax rates in a dramatical fashion. You alter tax approach dramatically by cutting taxes, and you get higher revenues. You don't get,
Silver's bullish potential isn't just speculation,
analysis.
It's backed by history and technical analysis. Let's start with the gold to silver ratio. Historically, when this ratio peaks at extreme levels, silver prices hit rock bottom before skyrocketing. And guess what? That pivotal point is nearing right now. Then there's the cup and handle pattern forming on silver's long-term price chart. This technical setup has been decades in the making, signaling a massive breakout is on the horizon. If silver can decisively break above the critical $1.34 resistance level, analysts predict it could climb to $1.50, and that's just the beginning. Add to that a shrinking supply and surging demand from clean energy and AI industries, and you've got all the ingredients for a historic rally. But here's the real question. Can silver break its all-time highs and sustain its climb to $1.75 and beyond? The answer lies in the next moves by central banks, investors, and global markets.
The money flows and the passive money flows do influence things to some extent and do make it harder to shut things off or to things get delayed. I would certainly agree that could be part of why this cycle is stretched out. But I think ultimately that only makes the fall bigger when it reverses. And then the amount of money it takes to blow it back up bigger. So that kind of fits into what I just said, I think, from a money flow standpoint a little bit. I'm not in the camp that is so focused. I think very short term, meaning the last month or two, we're back on that mantra of this is a narrow market. Most stocks aren't participating. It's a magnificent seven, or it's a small cadre of AI stocks, or what have you. I think people are overreacting. That was true, obviously, for a period of time. The Mag 7 dominated a year ago or a year and a half ago. Um, and that was certainly true. But under the surface, you were seeing things like industrials and some other groups that were participating. So, people acted like it was seven stocks. It wasn't. There were other things that were doing pretty well. It just was those seven were doing so well that you could statistically say they were accounting for the whole move. Um, but in a period of the time this year, middle of this year into the fall, we had a pretty broad market. The Mag Sevens took a rest, Nvidia took a rest, a lot of the semis took a rest, and you saw other groups come to the forefront. You saw some value start playing, and you saw the small caps actually come alive. The problem is, you got to November, and we've had a consolidation since, and people are looking at that consolidation and drawing conclusions, I think, that are faulty conclusions, because yes, we're back to where it looks like we're back.
With silver's trajectory set for explosive growth, the question isn't just when to invest, but how. Savvy investors are already capitalizing on dips, knowing the long-term fundamentals are firmly in silver's favor. So how can you position yourself to take advantage of this precious metal's rise? First, consider diversification. Allocating even 10-15% of your portfolio to silver, whether through physical bullion, EPS, or mining stocks, could provide protection against inflation and market volatility. Second, keep an eye on central bank behavior. With global institutions stockpiling silver and gold, their moves could offer critical clues about future price trends. And finally, don't overlook India's growing appetite for silver investments or the renewed interest in ETF. These undercurrents could further amplify demand. But here's a question to ponder. As silver takes center stage in clean energy, AI, and wealth preservation, will those waiting on the sidelines miss out on the opportunity of a lifetime?
It's an even bigger next cycle. So you've had this ratcheting up of excesses, imbalances, and monetary response. So now we're at levels where I think what comes at you bigger and faster, and the response is bigger and faster. And I think we're just at that point where it goes off the rails. It just goes through the roof on the upside in terms of the melt up, the blow off in the market, and then the excess build up. You get this crash in not just the markets but in the financial system, and it requires a far bigger response than we've ever had. We're operating in nowhere land, basically unprecedented territory. So no policymaker has ever been here before, doesn't know what to do. And part of what Powell's trying to do sincerely, in terms of saying we know the mistakes were made in the last 10 or 15 years, we're not going to repeat those. We're going to be more cautious. We're going to do things more incrementally. Part of why we're going to have the bust is because of that, right? Because they're going to be slow to respond to what would normally would cause a quicker reaction. But they're going to say, no, we don't want to do that again. And in delaying it, you get an even bigger downside. And then ultimately, when they finally realize this thing's out of control, they have to come in with both feet, and we'll see numbers we've never seen before. So it's kind of, I would call it almost inevitable that based on human behavior, you're fighting the last war, you're trying to overcompensate for what mistakes you made last time, and in so doing, you create even bigger problems.